If trade really starts to take a larger part of the conversation, what's the likelihood that that reacceleration was a one-off?
Well, I think with some of these companies, there probably was a one-off-ish element to it. Some of them had easing comps. And with Google, the issue really, the surprise really wasn't the Q2 reacceleration. It's still this question about what caused the ad revenue growth to decelerate so sharply in Q1. The Q2 results were kind of back to norm. If trade becomes a bigger issue, then the question is which of these companies has material exposure to China. And for long-term, bad, but near-term good, most of these companies don't have exposure to China, with the exception of Amazon, which as a retailer, as a distributor, obviously has a lot of exposure there. So they probably have the most China risk outside of, if you leave FANG, of course, there's Alibaba, which has enormous, it's all China exposure. So I guess that's how I would answer the question. I'd also make the simple point that if you look at the FANG names, you pretty much had acceleration, revenue growth acceleration for all four names, but there's a couple of very specific issues in the back half of the year. The ones that with the best fundamentals right now, with the easiest valuations, Facebook and Google.
Krish, what's the next iRobot? I mean, looking at hardware, who's got an amount of China exposure that could be really damaging?
You know, Apple clearly has a pretty high China exposure, and as you guys have mentioned before in this program, you know, anytime there's like a negative news on U.S.-China trade, Apple becomes kind of like the punching bag. What I would characterize as that overall what you have seen is that Apple has been trying to mitigate some of those risks, especially in China, given the fact that they have done some trade-in with the iPhone so that they can potentially solidify their market share or the iPhone unit sell-through over there. They had some pretty good strength on the services side, especially in calendar Q1, which typically coincides with the Chinese New Year, and there's a lot of game downloads that happens in China. The third thing I would also characterize is the fact that one other important step Apple is taking is the new Foxconn facility in India, which should eventually help them actually ship more into India without the risk of duties, and that will potentially help them gain more share in India that could offset future weakness in China.
Mark, I got to ask you about Netflix versus Roku. I mean, here's what I know you've been bullish on Netflix. You seem to have been kind of lukewarm on Roku, but it's had an amazing run, and now you're still not really behind it on valuation, even though you think Netflix has a lot higher to go from here. Did you miss something on Roku and its rise, and why are you still not completely on board?
Yeah, so we downgraded three mid-cap stocks that were phenomenal outperformers in the first half of the year: Trade Desk, LendingTree, and Roku. And of those downgrades are all valuation-based. The one that we clearly have gotten wrong is Roku. That stock continued to soar another 30% after our downgrade. They have got really the wins in their sales. And so, I think it's a very good asset. I would prefer to buy it on a pullback, and I don't know that I don't have a particular catalyst for it. They're a great play off of the streaming wars that are coming up later this year. We think they also have a catalyst in terms of international exposure, so we'll probably be ending up chasing it. Sometimes you get the valuation downgrades can be very tricky, and I think we got that one wrong. On Netflix, I find Netflix very interesting here. Look, this is obviously a contrarian call now with the stock down near 300. You pointed out before, the stock hasn't really done anything in a year and a half. There's all this overhang related to the Disney launch later this year. I'm just going to make the simple point that the content slate that's coming out of Netflix in the back half of this year is the strongest that the company has ever had. And so if they can't put up the best subscriber numbers that they've ever had, then there's a bigger problem. And I don't think there is. So we actually like Netflix. I think it's probably maybe the single best contrarian call in large cap outside of those outside of Lyft and Uber.
Although when they're spending $500 million, Mark, on 3 movies, I mean, how expensive is too expensive?
In terms of how much they're willing to spend, look, their cash spend is $14-15 billion a year, but they also have 150 million paying subscribers, and they're adding 30 million paying subscribers every year, which means that incrementally they've got $3 to $4 billion in extra spend to add on to that video ad spend. Look, have no doubt about it. There's going to be a day when Netflix is spending $20 billion a year on video content. If they have 250 million subscribers, they can do that and expand margins. That's the scale advantage that Netflix has. I don't care who they're competing against. Nobody has that kind of sub base, so therefore nobody can generate those kind of positive economics long term.
Krish, it's been amazing to see the volatility, the pullback, and then really the bounce back, the rally we've seen in semi-chips just in the past week with all of this ratcheting up of tensions between the U.S. and China. I'm curious, though, longer term. You've got China investing in its so-called big fund, which is aimed at the domestic chip industry in that country. You got headlines like the one today. Huawei's founder wants a, quote, invincible iron army to fight the U.S. Given the fact that we do have these dynamics between the two countries right now, do you think this is going to accelerate China's own development of its chip industry? And if it does, what does it mean for the U.S. semiconductor stocks?
Sure. I mean, I would say absolutely yes. China does have big ambitions, and they were trying to do everything that they can to accelerate the semiconductor industry. You know, the original concept was like a semiconductor industry by 2025, and clearly, like, they've fallen behind on that timeline. You know, the grand scale for them is to eventually compete with the Qualcomms of the world, the Intels of the world. But what is really enabling them is some of the semiconductor equipment companies like the Applied Materials, the Lam, and the KLAs of the world, where they don't have any viable second source to them. So at the end of the day, you know, I would say that a lot of China's semiconductor ambition really hinges on the semiconductor capital equipment sector, where they don't have a second source and they would need the U.S. help in that. And I think that's kind of where the whole debate amongst investors today is in, you know, how that is going to enable China to get to the next level on semis.
Finally, Mark, are you watching some of these expirations of Huawei licenses and exemptions as some sort of dramatic deadline?
Let's see, dramatic deadline for names like Google. No, I don't think so. I think it's largely a non-issue for Google. I mean, it's a small issue at the margin. I don't think it's actionable. And if there were a trade-off on Google shares because of that, I think that would create a better buying opportunity. I think it's almost immaterial to the biz.